only how much government is spending, because that's the true tax. Every budget is balanced. There is no such thing as an unbalanced federal budget. You're paying for it.
The U.S. national debt is over $35 trillion. In just the last week, public debt has jumped to over $345 billion, hitting a new record of approximately $35.7 trillion. Since June 2023, federal debt has risen by a massive $4 trillion, or 14%. And at the same time, US GDP has only increased by $1.5 trillion, or about 6%. In other words, the national debt has already outpaced economic growth by 2.7 times in just 16 months. Now, outside of the pandemic, the US federal debt has never grown this fast. So this is the first time in history. But you might be wondering, why should I even care about this abstract number? I'm going to explain and break down exactly what's coming, how it will continue to devalue your fiat currency and money, why the government will allow inflation to continue and rise, and how it will impact the United States of America. And lastly, what you can do to protect yourself. So interest payments on the debt alone are around $10 trillion, okay? This is a huge problem because the US government can't afford to pay back its debt or the interest. So this isn't about getting rich, guys. It's about protecting yourself and preserving whatever wealth you do have. So even if you're saving and investing in the stock market, you might still be wondering, okay, why am I not getting ahead? Your financial progress feels out of reach and you're just pretty much stagnant. And even if you're in the market with that 8 to 9% annual returns, you still feel like you're not getting ahead. And I'll explain why. That's simply because your gains are often compared to the S&P 500, which doesn't adjust for real inflation, which is much higher than the official CPI figures that the mainstream media suggest and what the news gives the public. While the S&P shows 8 to 10% growth on paper annually, that's the average, more than 80% of mutual funds and 401ks actually underperform. They underperform the index. Now, what's the reason? Because real inflation, or currency debasement is what it really is actually running closer to approximately between 10 and 20% on average. Now, central banks have been expanding the money supply by about, on average, 8% a year, almost mirroring the stock market returns. And that actually changed in 2019. They started stepping up to about 10% a year. So while your portfolio on paper looks like it's growing, you're really just breaking even. And as I said, since 2020, the money supply, so in 2019 they were increasing the supply by about 8%, but in 2020 they started to increase the monetary base, the money supply, even faster, which is around 10% a year now. Now this trend won't slow down anytime soon. I'm actually projecting it to even increase more in the coming years or even next year. So just look at the housing market, for example. In 2019, the median US home price was about $258,000. And in 2024, it's nearly doubled to about $492,000. So almost $500,000 for an average home. Prices have doubled already. And that's not even talking about the grocery store, that's just your average home. Prices have skyrocketed, not because value has increased, but simply because your currency is decreasing in buying power. It's losing its purchasing power. This is the biggest threat we're facing right now. It's currency debasement. The official 2% inflation narrative that the Fed has been giving the people and the mainstream media has been pushing is far from the truth. Now, currency debasement is what's really eroding your wealth. While stock market investments might keep pace with hidden inflation, they're not helping you get ahead financially. They're just keeping you afloat in a sea of rising costs, and you're barely breaking even for the most part. So with the US increasing its monetary base by around 10% annually, that means adding to the money supply on average 10%, you're not losing wealth, but you're not building any either. You're basically breaking even if you take it down to the simple math and do basic calculations. It's not rocket science. So how do we know they're about to start printing more money? Because earlier I did say they're going to increase the money supply more than 10% on an annual basis. Since 2019, they were doing it at 8%. Then after that, in 2020, they started doing it at 10%, and I believe they're going to increase it more. Now, why do I think that? I think that because they're going to need to inject more liquidity into the system. So Versan and I, we follow the money very closely, and that's how we know what's coming. So one reason we know currency debasement and that at rate that they're increasing money into the supply will increase, the reason we know that is because we watch what the central banks do and where the money moves. So, since 2009, all governments have reset their interest rates to near zero. This happened all over the world. It was a global cooperation between all central banks. And we've been in this 4 to 5 year cycle where the government's debt needs to be refinanced every 4 to 5 years on average since 2009. Now, since they don't generate enough income from growth domestic product, GDP, they have to create more debt and print more money to pay the interest on the previous debt. So this keeps compounding because they'll never print enough money to cover the interest, creating a never-ending cycle until something breaks. Now, the Congressional Budget Office, this is just another reason, but the CBO is projecting at least $20 trillion in additional debt, a minimum. And that means more debt and a growing money supply. And they said a minimum of $20 trillion in debt between 2025 and 2034. Pay attention to the timing. 2025 to 2034. Very interesting that they said this would start in 2025. And we're just noticing the global M2 money supply just starting to grow, which translates to more money printing. Now, this is why rate cuts are so important for the government, for debt refinancing. For example, you're financing a car, and then all of a sudden your interest payments, the interest rates get cut in half or down by half a basis point or 1%. Well, that's good news for you. You might want to refinance if it's low enough, because now your payments on a monthly basis would be cheaper. Central banks, governments, it's no different. They're actually borrowing money. Okay, it's like they have a unlimited credit card that they could just keep using and building up all this debt with interest on top of it. And it's a never-ending cycle. So the government's only option to avoid a systemic collapse or an overnight financial crisis is to actually lower the interest rates and increase the money supply, aka more money printing or quantitative easing, whatever they want to call it. They'll always come up with a new name because they know people start to catch on. Now, they don't have any other options. So this is why they're going to print more money. Now, instead of raising taxes, which is the government's main source of income, or directly taking money from the people to pay for their excessive spending, they'll just diminish your purchasing power through inflation caused by more money printing and increasing the global M2 money supply. As a result, inflation will keep rising, fiat currencies will continue to weaken, and asset prices will continue to climb. Another sign, as we just mentioned briefly, was the global M2 money supply is slowly starting to grow again. This means they're about to turn the money printers back on. And it aligns perfectly with everything else going on, especially the interest rates cuts that central banks around the world are synchronizing on together and moving at the direction where they'll all collectively ease at the same time. And that means cutting interest rates.
So what can you do to beat inflation and preserve your wealth, or even just get ahead financially? Look, the truth is, if you don't own assets, you'll only get poorer. If you do own assets, you'll either get richer or you'll break even, depending on the asset you own, which asset class you're invested in, and the stage of the market cycle. If you just want to keep up with currency debasement and the true rate of inflation, then the S&P 500 is your first and safest option. However, though, just be mindful that the majority of the stock market and companies are heavily overvalued. They have a lot of capital stuffed into some of these companies. Their stocks, some of them like Costco, are trading 55 times their earnings, so they're significantly overvalued, and that raises a concern for me. And I don't think that's the best option in terms of best risk-reward ratio. But if you want to maximize your returns and get ahead, what you'll need to do is invest in assets or own assets that appreciate faster than the rate of currency debasement and true inflation. So one example is gold, which has been around for over 5,000 years. Central banks have been net buyers of gold since 2009, right after the financial crisis. And the Bank of International Settlements, which is the BIS, the big bank of central banks, reclassified gold from a Tier 3 to a Tier 1 asset in 2019, just before central banks started to print more money more than ever in history, which is interesting timing again. I don't think that was a coincidence. I think they knew the money printers globally were about to be turned on and stimulated to the max. They felt like gold would be the safest option, zero counterparty risk. And that's why they moved it from a Tier 3, which was risky, to a Tier 1, zero risk, safest asset to own. So why gold though? Why would you even consider gold? Well, here's something you don't often hear. In 1929, 10 kilograms of gold could buy you an average home. In 2024, that same 10 kilograms of gold can buy you 2 average homes in America. So while house prices in US dollars keep rising, measured in gold, they don't. And that's because gold holds its value better than any asset out there. And that's the truth. The second option, and this is not more of wealth preservation, although it can be depending on how you look at it and what assets you're invested in and how long your time horizon is, that would be crypto and digital assets. They certainly do perform better than gold, but remember, crypto just started about 10, 13 years ago. And I do believe specific digital assets will be the foundation of the new financial system. It's kind of like buying Amazon, Google, and Microsoft, in the early 90s, okay? It's equivalent to that if you buy the right digital assets. The rest of it is a casino. You can win, you can make a lot of money, you could lose everything. Just be very careful because it is a speculative market. But again, the second is digital assets and crypto. And to me, this goes beyond wealth preservation because they outperform all asset classes, as I just said, including gold and currency debasement. Specifically, crypto and digital assets are currently the best risk-adjusted reward asset class out there and will continue to be so in the stage of the cycle where we are today. Now, most of them are currently, at the bottom of the market cycle. And they have a very strong correlation to the global M2 money supply, just like gold. So crypto and digital assets specifically have the strongest correlation and sensitivity to global liquidity. As global liquidity, global M2 money supply increases, digital assets and cryptos increase. As the money supply shrinks and decreases, crypto and digital assets come down. So they have the strongest correlation, stronger than gold, stronger than stocks, and stronger than real estate. Stocks, though, doesn't have the strongest correlation to global liquidity increasing, and the reason is because stocks can't just rely on global liquidity and credit creation. They also rely on earnings, which is a whole different topic and can reflect in their price. Now, in my next video, I'm going to be talking about why the global M2 money supply and money printing are strongly correlated with gold and cryptocurrencies in great detail, and why these assets tend to react more strongly and increase in price more than any other asset class out there, including the stock market. Now, once the money starts printing, I'm hoping that you guys already know where crypto and digital assets are going to go from this point. We've talked about this a lot, but in case you don't, the global crypto market cap will continue to increase as the global M2 money supply increases. So I hope you like this video. If you do, please give me your feedback in the comments. If you don't like it, let me know. That's fine. I would like your feedback. I really appreciate it. Just give me the truth, you guys. But until next time, I'll catch you soon. Thank you.